This is not just for California real estate. Actually, this is for real estate no matter where you are. And let's see. Hey, Marty, I need your help in getting my PowerPoint on the getting my PowerPoint going. So
on the bottom of your screen, it says share screen.
Yep, okay, got it. All right.
Open up PowerPoint and then click
Yep,
share
yep,
screen.
yep.
It's going. Yep, it's there.
Okay.
Turn on slideshow and then you should be good to go. Oh, you're on.
Let's see.
You got to share screen again. Okay.
There we go.
Yep. Okay.
Well, everybody, this is a topic that I am most passionate about, so I'm really excited to be sharing it with you. I want to begin by reading you this excerpt from the Wall Street Journal. A growing player in the real estate market is the so-called family office, in which an ultra-high net worth family, typically with more than $100 million in assets, joins with another wealthy family to buy investment property. Despite having ample cash, these families are looking for partnerships in order to lessen their exposure to risk. If real estate values were to tank, for instance, losses would be spread out over at least two parties rather than one family incurring the entire hit. Some families with expertise in housing look for partners that have built their wealth in other sectors. Others seek out real estate investors with a similar background in order to combine their expertise. Partnering up can help the family office get regional diversification. That way, if a market takes a turn locally, the families still have rental income from other locations. So the Wall Street Journal believes this topic that we're going to be talking about is something that all of you should know about, since it's something that's a trend with family offices. So welcome to why and what family offices need to know about real estate joint ventures. Now, whether you've never done a joint venture or you have, you need to understand why and what family offices need to know about real estate joint ventures. That's what this short webinar will teach you. I'm Jeff Lerman. I am the real estate investor's lawyer. I help clients nationwide with their real estate transactions. And for anybody who is a resident of California, we also help you with litigation and also estate planning. I'm also a real estate investor, and I am part of our family's single family office. And I've been featured on TV, radio, newspapers, past president of the Marin County Bar Association, and on. I won't bore you with the rest. A disclaimer, just because I am a lawyer, this seminar is offered with the understanding that neither I nor my firm, Lerman Law Partners, is engaged in offering you legal or other professional advice, and we have no attorney-client relationship with you solely by your receipt of this information. Any actions with regard to the information contained in this seminar should be undertaken only upon the advice and counsel of competent legal, tax, and estate planning professionals. A quick agenda here so you know where we're going. First, we're going to be talking about family office challenges with real estate, then the joint venture solution, the difference between a joint venture and syndication, why I believe joint ventures are the cheapest, easiest, fastest, and safest way to do real estate deals, and my special gifts for you, so make sure to stay to the end, where it's about a 20-minute talk here. And Q&A if we have time for it. So let's get going. By the way, don't need to write down notes from these slides. If you want a copy of the slides I'm about to show you, all you got to do is email me at jeff@lermanlaw.com, jeff@lermanlaw.com, and I'll be happy to send you a copy of all the slides. So let's talk about how joint ventures can help you real estate investing. And let me give you an example. I'm a very busy lawyer, so I don't have time to sift through 100 potential deals to find the one that actually makes economic sense. So I speak at events nationwide, not only to educate the attendees, but to try to find a deal or partner with a deal that does make sense. Now, I teach a private money boot camp for a major commercial real estate company in Boston. And at that event, I met somebody who had an apartment deal in Nashville that was an escrow, and she needed money to close the deal. Now, we ended up creating a joint venture where I brought the money to the deal that she needed to close, and she lived in Nashville. So I benefited from her having a deal that made sense and her knowledge of that submarket to give me greater diversity in my portfolio. That turned out to be a very profitable deal for both of us, and we became great friends that led to other deal opportunities. So that's an example of how a joint venture can help you. How joint ventures can help you in your real estate investing. Again, as the Wall Street Journal said, it can lessen your exposure to risk. If real estate values were to tank, and right now, we are at a point where this is the longest up market that we've had in my lifetime. And so there's no question there's going to be a correction at some point. So you have to be concerned about that. And so if real estate values were to tank, for instance, losses would be spread out over at least two parties rather than one family incurring the entire hit. It can give you access to another family office with the right amount of expertise in the sector you're currently in and or want to expand into. It can give you a greater diversity in your real estate investing, whether it's regional or minimal, less risk, and it can help you find that needle in the haystack investment that makes economic sense. Now, you might be thinking, I don't need a joint venture, I can just get whatever I need through syndication. Now understand, I'm not saying syndication doesn't make sense. In fact, our office does syndications as well as joint ventures, and sometimes we do a joint venture and a syndication in the same deal. But I want to open your eyes to understand why and when you don't have to syndicate, but you can do a joint venture instead. So the biggest problem with syndications is that they can be expensive. They're more expensive than for in terms of legal fees, they're more expensive than what is involved to create a joint venture agreement. They can be too complicated because syndication, unless you are a securities attorney, you don't know what you don't know when it comes to syndication and the securities laws. And so it's very easy to inadvertently violate the securities laws without even knowing it. It can be too risky for the same reason. It takes too long. It takes usually about 30 days for us to complete a syndication, to create your syndication documents. And then after we create those documents, then it takes time for you to get people to invest in your syndication. And a lot of times, family offices don't have that kind of time, especially if they've got a deal that's under contract. And there's not enough usually, and not enough pre-existing substantive relationships, which are essential if you're using the most common SEC exemption to the securities laws. So what's the solution to not having to deal with syndication? Joint ventures, not just joint ventures with the right partner, but not just joint ventures with the right partner, but joint ventures with the right partner that have been properly set up. Now, why do I say that have been properly set up? Because I have litigated partner disputes, and every one of those disputes could have been avoided if the partners had the right joint venture agreement. We did not prepare the joint venture agreement for any of those disputes. They were prepared by somebody else, and they were defective. So it's absolutely crucial that you have an experienced lawyer prepare your joint venture agreement. So let's talk about what's essential to make sure you have a true joint venture. Let's make sure you understand what I mean by joint ventures. The dictionary definition of a joint venture is the coming together of two or more people for a common business purpose. But that definition doesn't apply in real estate because of the securities laws. Under the securities laws, in order to have a joint venture that does not require you to comply with the securities laws, you need two things for each of the joint venture partners. You need, first of all, for all partners to be actively engaged. That's in quotes for a reason. Actively engaged. So, and a lot of people don't know what I mean by actively engaged. So let me give you an example to explain what active engagement looks like. I did a residential subdivision development deal, and we did it with a joint venture, just like what I'm talking to you about now. And there were 4 people in the deal, which, by the way, a lot of people say, how many people can you put into a joint venture? And this example will help you understand a possible answer to that question, but there's more beyond that. But there were 4 people in this deal. There was the guy who found the deal and got the loan. There was the developer who was doing the primary development work. There was the real estate broker who was helping in the design of the homes and is also handling the sale of the homes. And there was myself. I was doing the legal work, and I also brought the money to the deal. So in that scenario, you had 4 people in a development deal, and each one was actively engaged in a particular part of what was essential to make that development deal happen. And so that is an example of what active engagement looks like and how you can document it. And the way we documented it is that all of the 4 of us, we were each in different cities. But every week we got on a conference call, and one of the people was the secretary for that call and took copious notes of what we discussed. And so what we had was all those, all of the documents which showed what we discussed, when we discussed it, who said what, and so there could be no question that we were all actively engaged in that deal. So hopefully that answers your question as far as what does active engagement mean? And which, by the way, there could be more than 4 people. It really depends on the deal. And the second thing that's essential to have a true joint venture is that each person has to have enough real estate experience so the SEC doesn't have to worry that they didn't know what they were doing. So those are the only 2 things that you must have to have a true joint venture. If you miss either one of those, it's not a joint venture, and you have to comply with the securities laws. Now, what this talk is not about is it's not about partnerships with passive investors. So passive investors, passive is a term under the securities laws. Passive means all the investor is doing is giving you money for your deal, and then they're sitting back and waiting for you to do whatever you need to do to make them a profit. So this is not about that. This is not about syndication, and it's not about the securities laws, because with this, the securities laws become irrelevant. Let me explain why I say that this joint ventures are the cheapest, easiest, fastest, and safest way to overcome your investing challenges and achieve your real estate success goals. Cheapest. I say cheapest because, again, in my experience, a joint venture costs a fraction of the cost of syndication, not only for legal fees, but for everything else that goes along with a syndication. So if you go with a joint venture instead of a syndication, you can stretch your dollars and you can seed more deals with the money that you'll save. Why do I say the easiest? Because think about it. There's so much to do when it comes to real estate. You have to sift through dozens of deals to find one that makes any sense. You have to analyze the deal. You have to do the due diligence, find the loan, deal with the lender, find the money, manage the asset, manage the manager, and sell the property. So much to do that, and because of that, it feels like you got the world on your back to get a deal done. And if you have a joint venture partner, all of a sudden, you've got that partner power and you've got somebody to share that burden with. So all of a sudden, all of that becomes so much easier for you to accomplish. So that's a big part of it. Why do I say fastest? Because think about it. If you do a syndication, it takes so much time to have your lawyer create all the paperwork for a syndication, and then you have to do all that you're required to do to find enough investors to make your deal happen. But if you have a joint venture partner, you can eliminate all of that because you have the right joint venture partner to give you whatever you need for the deal. Safest. Why do I say safest? Because think about it. It's really talking about diversification. So is it better to have all your eggs in one basket or to spread them out? Which is safer? Diversification. And when I say diversification, Lots of ways you can diversify. You can diversify by asset class. Maybe what you usually do is just multifamily deals, but you want to expand. Maybe you want to do office deals. Maybe you want to do land deals. Maybe you want to maybe you want to do retail. Whatever it happens to be, you can expand into. You can diversify your asset class. You could diversify geography. Instead of just investing in California, you can go outside California, which is what we did. We started diversifying outside California, and we did great with that. And you can diversify your risk. You could diversify the risk that goes along with your asset class. You can diversify your risk as far as the geographical location. You can diversify a lot of different risks. So that's why it's safer. But I think the aspect of joint ventures and the benefit that is most significant, in my opinion, is something I can best describe with a case study. So let me share it with you. There was a case study that we did not too long ago, and I had a client who had a deal under contract. However, it was during a downturn, and he wasn't sure how long the downturn would last and how much worse it would get. Again, very similar to where we are right now in terms of when is a correction going to happen. So he was going to pass on it, and he called me to ask for my advice. And I told him what I'm telling you about joint ventures. I said, look, if you're about to pass on the deal before you do it, then try to find another sophisticated investor and see if they would want to partner with you on the deal. That way, you'll get a second opinion from somebody who's willing to put their money where their mouth is instead of looking for an investor in a syndication. And you're not going to ask the investor in a syndication if they think your deal's a good deal. You're supposed to they should be assuming that it's a great deal because you're doing a syndication. So he took my advice, and the partner he found said he was pretty confident the downturn was almost over, and he was willing to be a 50% partner in the deal. So they moved forward with the deal. Now, as it turned out, the downturn ended the next month, and that property doubled in value within 6 months. Now, that happy ending is nice, but that's not the point of the story. It really doesn't matter what happened with the deal. What matters is that finding a joint venture partner will give you a crucial second opinion from a knowledgeable investor who's willing to put their money where their mouth is, which will make you feel better regardless of what you end up doing with the deal, whether you go forward or pass. Plus, that client created a new relationship with that partner that led to more deals, which helped them both to build their portfolios. So what's the takeaway? The takeaway for the benefits of a joint venture is you get a second opinion from an investor who's able to put his money where his mouth is, as opposed to just getting opinions of consultants. You get credible input to help you reevaluate your risk assessment for this, which is huge because risk assessment is crucial in real estate and future deals. You get the deal done instead of passing or making you feel better about passing on the deal if that's your decision. And you get a new relationship with more deal flow and more done deals. And finally, better risk diversification in your portfolio. So for all those reasons, that's why I believe that a joint venture can give you true peace of mind when you invest in real estate, especially at this particular time in our economy, and it will help you in success for your real estate investments. Now, the gift I wanted to give to you is I have two special reports that I think will help you explore this further. One is called 17 Steps to a Successful Joint Venture, and the other is 12 Warning Signs You're Headed for a Lawsuit with Your Partner. And both of these can really help you in understanding more about this very important topic. If you want these free gifts, all you got to do is send me an email to jeff@lermanlaw.com and just put free gifts in the subject line, and I'll be happy to talk to you about that. And with that, I will open you up for Q&A.
Hey, Jeff. So, there's a lot of I think there's a lot of risk in the market right now. you suggest that people, do joint investments. And so talk about like the best joint investment partners that you think there are out there.
The best partners are going to be, you have to look at what you are looking for that you don't currently have. That's what happens. In our family office, which has been around for decades, and most of the deals we've done came to us because we had the right joint venture partner at the beginning who kept bringing deals to us. And so if that's your need, if what you need, like again, myself, I got a law firm, and I don't have time to look at 100 deals to find one. So for me, that was my need. And so the best partner for me is somebody who is sitting here in this event, who's a family office, and they've got a deal, but they don't have the money. That would be great for me. Or anybody who's got a deal, that's always been my best joint venture partner. But if you do have the time, if your skill set is to find great deals, and there are people out there like that, then what you probably need is somebody who's got the money to help you do what you do best, and they can get you the money you need. So whatever it happens to be, that you don't have, that's what you want to be looking for in your joint venture partner, or in that residential subdivision development deal. I could do what I do, but I'm not gonna design the building. I'm not going to do the development, and I didn't find the deal. So I think if you think about it that way, it becomes much easier.
Jeff, can you go back one slide to your gifts? Because I want to talk about something.
Sure.
So when you're looking at a partner, I mean, obviously you advise and you review legal agreements on these partnerships. Any key indicators? Do you do risk assessment or analysis of the partner for your clients? Do you like say, well, this guy litigates a lot, or his history is pretty good, or do you look at that stuff in advance? Or
yeah, great question. And that's actually a huge part of what we do that has gotten us to the point where none of our joint ventures have ever ended up in a lawsuit, which is one of the primary concerns that we always have when we are setting our clients up in a joint venture, because we want to keep you out of a lawsuit, out of court, and hopefully even minimize the potential of a dispute. And so we have a particular process that we go through, and the process is essentially this. Let's keep it simple. Let's just say there's two of you. And so what we do is I give each person a memorandum of understanding template that I created that has what I believe are the most essential terms in a joint venture, and I leave blanks in each of those terms because I want each of those investors to fill in the blank with the words that they believe need to be filled in that blank to make that particular term something that they want. And when I do, and I tell them, don't do this together, do it separately, don't discuss it, don't do any, just do it on your own, and then send your completed memorandum of understanding to me so I can take a look at what each of you said, so I can determine from the very beginning how much you guys are on the same page. And I can see if somebody does something, filled it out one way and the other one did it another way, then if it's something significant, what I'll do is I get everybody together. We used to do it in person. Now we're doing it more in Zoom. And we discuss it. I say, okay, well, you said this, you said that. Let's talk it through and see if we can resolve this particular difference. And I watch when I'm doing, and I'm very open with them. I tell them exactly what I'm doing. I say, look, I got no dog in this game. I want to make sure that you guys are communicating effectively and that you seem like you're going to be okay in dealing with there's always going to be something that comes up. I want to understand how they communicate. And so I watch that, and sometimes I will tell them, look, on this or that, it seems like you guys really were not communicating very effectively. So I think maybe what you should do is go back and you should try to work through this particular aspect of your deal, and let's see if you guys can come together. And if you can't, then I think maybe you should rethink whether this is a good fit for you. And that's just a quick summary of what I do, but I do firmly believe that because of the way we do it, it really front loads all these potential problems, and we deal with it up front, which is where it should be dealt with.
And just real quick, so what are the, is there a standard contract that people work from? Because, you know, what I notice, especially in real estate, there's some volatile people, right? Like, you know, who maybe they have like little fiefdoms and they feel like they own their fiefdom, right? And then number two is that, you know, there's a lot of people who are lawyers in the business. I've always thought that people who own the contract have a strategic advantage over people who are signing a contract.
Well, the joint venture agreement that we have with is we start with a template that I've developed over the years, and then we customize it for each person because everybody's got their own specific provisions that they want to make sure. And a lot of what we do actually is pull people back, because it's very common for people to unnecessarily overcomplicate what they think they want to do in a particular deal. And so that's another way that we keep their expenses down. But yeah, we start with a joint venture agreement that we get whatever their final memorandum of understanding is. So we get more information from that. And then I say to each one, I say, tell me what's most important to you and what you're most concerned about, to make sure that, because I can't read your mind, and so I want to make sure that what we include in the joint venture agreement is not just what we think is important, but what you think as the partner is something that you want to make sure is addressed, because there's always something. And I can usually, at this point, after having done this for several decades, I'm pretty, there's not too much I haven't seen, but there's still always something that could pop up. So yeah, we really want to make sure, I keep coming back to this joint venture agreement as at the very beginning, it's the best opportunity that I as the attorney have to make sure that my clients are going to have a successful joint venture and stay out of a lawsuit.